Over $2.5 trillion in Asian dollar reserves may be offloaded, while the U.S. faces growing isolation in global trade. How might a shifting economic order in Asia impact American households and jobs? Over $2.5 trillion in U.S. dollar reserves held by Asian economies could soon be sold off, according to economist Stephen Jen. This reserve buildup stems from decades of trade surpluses with the United States and has traditionally been invested in U.S. Treasury bonds, real estate, and equities. The Bloomberg Dollar Index has fallen 9% since January 2025, while regional currencies like the Chinese yuan, Taiwanese dollar, and Malaysian ringgit have all appreciated in recent weeks. These moves suggest a gradual diversification away from the U.S. dollar in central bank portfolios across Asia. If this sell-off accelerates, the dollar may weaken further. A weaker dollar typically drives up the cost of imported goods. For American families, this could mean higher prices on everyday essentials, such as groceries, gasoline, and electronics, exacerbating the ongoing pressure from consumer inflation. China and Japan and South Korea have signed a new agreement to deepen trade cooperation, marking a pivotal shift in regional dynamics. The accord aims to ease long-standing diplomatic tensions and bolster joint supply chains, reinforcing the existing Regional Comprehensive Economic Partnership, or RCEP, the world's largest trade deal. Analysts see this as a significant move to establish a trade architecture independent of U.S.-led systems, effectively redefining Asia's economic future without American oversight. With tighter Asian integration, American firms could face steeper barriers to entering key East Asian markets. This realignment threatens U.S. exports and may prompt some manufacturers to relocate or lose competitiveness, posing risks to jobs in tech, auto, and industrial sectors. The U.S. is increasingly viewed as a trade outlier, according to a recent Telegraph report, which highlighted global skepticism toward America's economic reliability. Critics cite unilateral tariffs and financial sanctions as key reasons why nations are recalibrating away from U.S. trade norms. IMF data shows the U.S. dollar's share in global foreign exchange reserves has dropped from over 70% to below 60% in the past 2 decades. The erosion reflects waning trust and a broader desire for multipolar economic leadership. As trade partners seek alternatives, U.S. exporters, particularly in agriculture, manufacturing, and technology, may face declining demand, reducing profits, and putting jobs at risk in trade-dependent regions of the country. Russia and China have shifted most of their bilateral trade into their own currencies, bypassing the dollar entirely. Speaking last week, Russian President Vladimir Putin confirmed that a majority of Russia-China transactions are now settled in rubles and yuan. Simultaneously, countries in the global south are investing in new payment systems and financial platforms to avoid using the U.S. dollar, reflecting a growing push for de-dollarization. A diminishing role for the dollar in global finance could raise borrowing costs at home. As international demand for dollar-denominated assets declines, interest rates on mortgages, car loans, and credit cards could rise, making debt more expensive for American consumers. Amid rising trade tensions, key U.S. agricultural exports, soybeans, coffee, and nuts, are experiencing sharp declines. As traditional markets gradually fade, the pressing question remains, can American farmers weather this growing crisis? In 2025, U.S. soybean exports to China are expected to drop by 20%, falling from 1.865 billion to 1.5 billion bushels, as China shifts its sourcing to Brazil and Argentina. At the same time, American coffee roasters are facing mounting uncertainty due to tariffs of up to 46% on coffee from Vietnam and 32% on imports from Indonesia. These duties have raised costs and disrupted supply chains. Meanwhile, U.S. nut exports to China have declined by 82% in 2025, down to 9,571 metric tons, as retaliatory tariffs from Beijing prompt a pivot towards suppliers in Australia and Chile. This contraction in agricultural exports has not only affected farmer incomes, but may also lead to price volatility in domestic commodity markets, with potential consequences for household spending. Farmers, particularly in the Midwest, are bearing the brunt of export losses and falling commodity prices. Many have been forced to sell assets or seek employment outside of agriculture to sustain their livelihoods. Farm income is projected to decline by over $40 billion in 2025, marking the steepest drop in modern history. This downturn is not solely attributed to trade tensions. It is compounded by rising input costs, such as fertilizers and equipment, and adverse weather conditions, including prolonged droughts affecting crop yields. These factors have led to increased financial strain on farming operations. The decrease in farm revenues may result in reduced investments in agricultural technology and infrastructure, potentially hindering long-term productivity and sustainability. Additionally, the financial stress experienced by farmers could have ripple effects on rural communities, impacting local economies and services that rely on the agricultural sector. In response to these challenges, there is a growing call for comprehensive policy measures that address both immediate relief and long-term resilience in the agricultural industry. This includes exploring new markets, investing in sustainable farming practices, and providing support for technological innovation to enhance competitiveness in the global market. Once the largest buyer of U.S. agricultural products, China has increasingly diversified its sourcing, signing long-term contracts with countries such as Brazil, Argentina, and Russia, extending through 2030. Even with a temporary 90-day tariff reduction agreement between the U.S. and China, many Chinese importers continue to favor goods from countries unaffected by U.S. tariffs, diminishing the competitiveness of American exports. Losing access to this vital export market could lead to domestic oversupply, further pressuring prices and farm incomes. Global food prices are expected to rise as a result of ongoing tariff and counter-tariff measures, placing additional strain on consumers and creating uncertainty for nations that rely heavily on agricultural imports. The U.S. government is reportedly reviewing relief plans for farmers, though no concrete action has been announced, leaving many in the agricultural community feeling overlooked. For American households, particularly those with fixed or limited incomes, rising food prices may increasingly challenge daily spending patterns.
China has just halted all capital flows into the United States. This is triggering a shockwave across the global financial landscape. Businesses are reeling. Prices are on the rise. Could this be the beginning of a silent yet significant currency war? According to Bloomberg, as of March 17, 2025, China has officially banned outbound capital flows to so-called hostile countries, including the United States. This expansion of its capital control policy has brought Chinese foreign direct investment in the U.S., which had already fallen from $46 billion in 2016 to just $2.3 billion in 2023, down to virtually zero. At the same time, China has continued to sell off U.S. Treasury bonds, offloading $14 billion worth in 2024 and reducing its total holdings to $775 billion, its lowest level since 2016. A continued reduction in Chinese demand for U.S. bonds could put upward pressure on interest rates. That means higher borrowing costs for homes, vehicles, and credit cards for American consumers. Conversely, in the first quarter of 2025, China increased its investments in ASEAN nations by $19.4 billion. This shift may enhance Southeast Asia's ability to attract infrastructure and technology investment. Additionally, China has accelerated the use of its digital yuan, which is now integrated with the SWIFT Light Payment Network in 13 countries. This enables transactions without using the US dollar. In 2023, foreign direct investment into the United States hit $148.8 billion, a 28% drop compared to 2022. That's well below the 2014 to 2022 average of $265.6 billion. This downturn has made it harder for businesses to expand and hire, especially in manufacturing, where foreign capital is crucial, and that's putting pressure on employment and household income. As of December 4th, 2024, just $59 billion in new high-yield or junk bonds were issued, lowest level in over a decade. Nearly 80% of that used for refinancing, not growth. It shows a widespread sense of caution among investors and corporate leaders. Meanwhile, average interest rates on junk bonds jumped from 5.2% in 2022 to 9.6% in 2024. Borrowing is now way more expensive. That means businesses may scale back on investments, cut hiring plans. And that could mean fewer job opportunities and higher consumer prices. In summary, the slide in FDI and the contraction of the junk bond market are putting serious financial stress on businesses. Market confidence is taking a hit. And the cost? It's showing up in everyday life. Cost of living is rising. Income stability is slipping. Several major projects in the United States have stalled due to a lack of capital from China and Taiwan. We're talking about an $8 billion battery plant in Michigan, a $3.1 billion robotics center in Nevada, and Intel's massive $20 billion project in Ohio. These delays are hitting employment and income hard, especially in the states where these projects were set to roll out. Right now, 62% of U.S. businesses planning to expand production are reporting a shortage of foreign investment. This has forced many of their plans to be postponed. That means fewer jobs and a slower recovery for domestic manufacturing. Beginning March 4th, 2025, the U.S. increased import tariffs on a wide range of goods from China from 10% to 20%. While aimed at supporting domestic production, this move has led to a sharp rise in consumer prices, particularly for household appliances, which have risen by 16.7% year over year. Inflation is projected to hit 3% in 2025, the highest level in several years. That's pushing households to tighten spending. Big time. According to the National Retail Federation, American families could see an extra $1,950 in expenses for goods by the end of the year. Car prices are rising, jobs are gradually disappearing, and Americans are struggling in the midst of a shifting economic landscape. What is happening to the auto industry, once the pride of the United States? Tariffs and protectionist trade policies have driven production costs sharply higher, pushing the price of American-made vehicles to record levels. According to Edmunds, by early 2025, the average price of a new car has surpassed $50,000 USD, while used vehicles are nearing $32,000 USD. With incomes failing to keep pace, many consumers are left with no choice but to hold on to older cars, even as maintenance costs continue to rise. Cox Automotive reports that a standard oil change, once around $50 USD, now exceeds $100 USD. Hourly wage earners and those on fixed incomes are bearing the brunt of this burden, particularly as broader living costs, from groceries to gasoline, rise in tandem with the new wave of tariffs. McKinsey notes that 75% of American consumers have shifted to buying cheaper goods, primarily food, due to tightening household budgets. At the same time, unemployment is spreading. The manufacturing sector is seeing a jobless rate of 5.2%. Construction has shed 34,000 jobs. And agriculture has experienced a 3.8% reduction in its workforce. These losses stem from rising raw material costs, declining export demand, and widespread order cancellations. all of which are forcing families to cut back on spending, weakening purchasing power across the broader economy. As American car prices rise and deliveries slow due to parts shortages, Japanese and Korean automakers are gaining ground, thanks to competitive pricing and more agile supply chains. In 2024, Toyota captured 12.5% of the U.S. market. Hyundai Kia held 10.2%, and Honda accounted for 8.1%. These vehicles are known for their durability and fuel efficiency, qualities especially valued amid the steep increase in fuel prices, driven by new import tariffs. Hyundai has announced plans to invest $21 billion by 2028 to build electric vehicle and steel manufacturing facilities, expected to create an additional 100,000 jobs and stimulate regional economies. In contrast, many American automakers have been forced to scale back production due to rising costs, leading to widespread layoffs. This has reduced consumer access to domestic models, while further pushing up the price of American-made cars. The shift toward Japanese and Korean vehicles also reflects a broader trend, a trend toward more frugal consumer behavior. With U.S. economic growth projected to slow to 1.4% in 2025, down from 2.2% previously, according to McKinsey, many Americans are adjusting their spending habits in anticipation of leaner times. The 25% import tariff has driven up car prices by an average of 13.5%, or roughly $6,400 per new vehicle. This price spike not only strains consumers, but also directly affects manufacturing and exports. Ford has halted exports of the F-150, Mustang, and Bronco to China in response to retaliatory tariffs of 150%. Stellantis has laid off 900 workers across 5 plants, while Volvo has announced job cuts ranging from 550 to 800 positions. Current trade policies are weakening the U.S. auto industry, leading to declining revenues, job losses, and reduced access to domestic vehicles for American consumers. Without timely adjustments, U.S. market share for American-made cars could fall below 40% within the next 5 years. The inflationary pressure driven by tariffs is also spreading to other sectors. In agriculture, the unemployment rate surged to 12% in March 2025, the highest in years. This reflects the broader, cascading impacts on the overall economy and the daily lives of millions of Americans. Prices are rising, spending is tightening. Millions of Americans are feeling the effects of President Trump's new tariff policy. But behind the numbers, is there something even more troubling? On April 2, 2025, President Donald Trump announced a sweeping 10% tariff on all imported goods, along with higher rates for specific countries. This move pushed the average U.S. tariff rate to approximately 24%, the highest level since 1909. Economists at the Penn-Wharton Budget Model, PWBM, estimate that the tariff policy could result in an 8% reduction in GDP and a 7% drop in wages. A typical household could face a lifetime economic cost of up to $58,000 due to these changes. Additionally, the tariffs are expected to raise prices on essential goods such as fruits, vegetables, seafood, coffee, and wine, impacting everyday spending for millions of Americans. According to Bloomberg, the Trade Policy Uncertainty Index has reached its highest point on record, surpassing the 10-point mark. The increase signals growing concern over the direction of U.S. trade policy. In response, many companies have delayed investment and expansion plans. A study by Goldman Sachs suggests that heightened uncertainty could reduce business investment growth by around 5 percentage points over the next year. Financial markets have also felt the impact. IPO and M&A activity has slowed, with companies like Klarna and StubHub postponing public listing plans amid an unstable economic outlook. As reported by Business Insider, several CEOs are finding it difficult to make strategic decisions in light of policy unpredictability under the current administration. Goldman Sachs has revised the 12-month recession probability for the United States to 45%, up from 35%, citing the effects of new tariff measures. Equity markets responded swiftly. On April 3rd and 4th, the S&P 500 fell by more than 10%, the steepest two-day drop since the COVID-19 pandemic. The Dow Jones Industrial Average lost over 4,000 points, equivalent to a 9.5% decline in value. Notably, the top 10% of income earners account for nearly 50% of total consumer spending, making shifts in their financial behavior a key concern for broader economic stability. Historically, U.S. government bonds and the dollar have been considered safe haven assets during periods of economic uncertainty. However, both are now experiencing sell-offs, reflecting shifting investor sentiment toward U.S. financial assets. The yield on the 10-year Treasury note has surged from 4.01% to 4.58% within a week, the sharpest rise since 1982. The U.S. Dollar Index, DXY, which tracks the dollar against a basket of major currencies, has dropped more than 4% in April, marking its largest monthly decline in over a decade. The downturn signals mounting concern over the trajectory of U.S. trade and fiscal policies. According to the U.S. Bureau of Labor Statistics, the Consumer Price Index, CPI, rose 2.4% year-over-year in March 2025, slightly down from 2.8% in February. However, core inflation, which excludes food and energy, remained at 2.8%, suggesting continued price pressures. President Trump has publicly urged Federal Reserve Chair Jerome Powell to cut interest rates, arguing that such a move would support economic growth. Rising inflation could affect household spending, particularly in areas like food and energy. If the Federal Reserve does not lower rates as expected, borrowing costs, such as mortgage and auto loan rates, may remain elevated, putting additional strain on household budgets and investment decisions. EU diversifies partners, looks to internal market to counter potential 144 billion euros loss. Could these strategies safeguard Europe's supply chains and global standing against pressure from Washington? In 2023, the European Union was the world's largest trading power, accounting for 16.1% of global trade, valued at 7.6 trillion euros, according to Eurostat 2024. The U.S. remains the EU's largest trade partner, representing 17% of EU trade, equating to 1.6 trillion euros. However, this trade relationship lacks any free trade agreement, FTA protection. Under former President Donald Trump, the U.S. imposed tariffs of up to 25% on imported cars from the EU and 10% across the board. Alarmingly, Trump's trade advisors are suggesting a return of a 20% tariff on all EU goods within the first 3 months if he re-enters the White House, according to Bloomberg. According to the European Commission, a retaliatory tariff war at 25% could reduce EU exports to the U.S. by 17.5%, causing a direct loss of 0.54% of the EU's GDP, which is equivalent to 144 billion euros, according to a European Commission trade impact study. U.S. consumers would face sharp price increases on imported goods from Europe, including cars, wine, and industrial equipment. The Brookings Institution predicts core inflation could rise by an additional 0.3 percentage points if these tariffs are reinstated, according to Brookings. To reduce dependency on the U.S., the EU is accelerating FTA negotiations with emerging economies. India is a top priority. If an FTA is concluded, the import tariff on cars could drop from over 100% to just 10%, according to Reuters. Bilateral trade between the EU and India is projected to reach 167 billion euros by 2026, with EU exports totaling 75 billion euros and imports from India reaching 93 billion euros. Additionally, a deal with Mercosur, Brazil, Argentina, Paraguay, and Uruguay could boost total trade to 126 billion euros. with the EU exporting 77 billion euros and importing 49 billion euros. For Mexico, improving market access alone could increase EU exports by 20%, or 10 billion euros. In total, if all three FTAs are approved before 2026, the EU could recover around 91 billion euros, though it would still fall 53 billion euros short of the losses from the US. Alongside expanding partnerships, the European Commission is calling for improvements to the EU's single market, established in 1993. While barriers to goods have been removed, three key pillars, services, capital, and labor, still face significant hurdles due to national laws. For example, Polish plumbers must recertify to practice in Belgium. Startups in Portugal struggle to raise funds from the Netherlands due to differing investment laws. And EU citizens face bureaucratic obstacles when working in other member states. According to a new study by the European Parliament, this lack of integration costs the EU 1.1 trillion euros annually, 279 billion euros from services, 415 billion euros from the digital market, 300 billion euros from goods, and 50 billion euros from public procurement, according to European Parliament policy study. If reforms are implemented, the EU could fully recover the 144 billion euros loss from US tariffs, while also boosting its internal competitiveness. Financial markets are rattled as the US-China trade conflict enters an unprecedented phase. Interest rates are climbing, and the US dollar is losing ground. What lies ahead for the American economy? As of April 11th, US financial markets have experienced notable declines. The S&P 500 has dropped 8.8% since the start of the year, while the Nasdaq Composite has fallen 13.4%. The Dow Jones Industrial Average is also down 5.5%. Alongside equities, the yield on 10-year U.S. Treasury bonds has climbed to 4.5%, reflecting concerns over inflation and potential future interest rate hikes. The U.S. dollar has weakened, particularly against the euro and the Japanese yen. In contrast, gold prices have increased as investors shift to safer assets in response to currency depreciation and ongoing market instability. Over the past week, President Donald Trump announced a significant increase in tariffs on Chinese goods, bringing the total rate to 145%. This includes a 10% base tariff, a 125% reciprocal tariff, and an additional 20% aimed at addressing fentanyl-related issues. These measures are intended to encourage domestic manufacturing and reduce reliance on foreign supply chains, especially in critical sectors such as semiconductors and pharmaceuticals. China responded by raising tariffs on U.S. imports to 125% and stated it would not escalate further, regardless of future American actions. Additionally, China has imposed restrictions on the export of key resources like rare earth minerals, impacting U.S. defense and high-tech industries. These developments have contributed to global market fluctuations, with record gold prices, rising bond yields, and a continued weakening of the dollar. Across Europe, several countries are actively exploring deeper economic ties with China. Recent talks and agreements between the European Union and Beijing underscore a growing shift in international trade dynamics. One prominent area of cooperation is the electric vehicle sector. The EU and China are discussing the implementation of a minimum pricing mechanism for Chinese EVs imported into Europe, which could replace the current high tariff structure. Previously, the EU imposed tariffs of up to 35.3% due to concerns about state subsidies, but the ongoing negotiations aim for a more balanced and sustainable solution. Beyond EVs, discussions are also advancing in renewable energy and clean technology. During a recent visit to Beijing, Spanish Prime Minister Pedro Sánchez highlighted the importance of strengthening bilateral trade and investment in these emerging sectors. President Trump came under scrutiny last week following a social media post made on April 9th via Truth Social, in which he stated, "Now is a great time to buy," alongside the stock symbol DJT, referring to Trump Media and Technology Group. Just hours later, the administration announced a partial delay in retaliatory tariffs, maintaining a 10% base tariff on most trading partners.